Hey, this is Sasha. Thanks for joining me in today's video. And in today's episode, we're going to talk about why most professionals, not really why, but I'm going to share with you some insight on many professionals. They really don't trade zero DTE options, at least not at a core level, meaning not as a core strategy. There are some, I will give you that. There are some professionals that will do that. But a lot of people that really understand options, meaning the professional grade, they don't trade a lot of zero DTE options. And that, in part, that is also because their account is a little larger, so they're not always looking to trade zero DTE options. I'll explain that in a bit here, just a second, as we get into this video. But if you're seeing a lot of YouTube videos promoting and hyping zero DTE, it's because a lot of people online are looking for a get-rich-quick concept. They're looking to make money fast and quick in 0 days, right now, immediately. We also think psychologically as for making money today on a day-to-day basis, because that's what happens in the real world. On a job, you go to job, you get paid. You go to job, you get paid. You go to another job, you get paid. So as you do the job and task, you get paid. Investing and trading works a little bit different. The function that you put on a trade, let it work, let it do its thing, and then the returns come later, is the way that it happens. It's completely different than what many other people think in the day-to-day world. So what I want to get started with you here on the zero DTA options is that I want to show you why you should almost learn to get away from them a little bit more so as a core strategy. Again, I'm not saying they're bad from a, hey, part of your trading arsenal, but getting away as a core and only strategy is a problem. Okay, and here's kind of the reason behind it, because as we start looking at zero DTE trades, and as I start pulling these things up, zero DTE, what a lot of people don't recognize is you're putting a lot of capital in there, and it's fine for, let's say you got $5 grand, and maybe you put on an iron condor on the SPX, and you put in like $3 grand in there, and you know you're making money, and it seems good, like day in and day out, every day you're making capital. But then all it takes is one big move to take you out. So if you take out, let's say $3,000, that sucks. But $3,000 can come back quick enough, right? In the real world, you go to work and yeah, it hurts, but it can come back to you. When you start talking about, let's say, I'm going to start going a little larger here. Let's say $300,000 account, and you put all of that money, you put all your money into an iron condor that's 0 days, and you're blowing a $300,000 account. All it takes is for this thing to go down. Maybe you're down 250 grand in one trade, and that is nasty. Okay, so you need to be very mindful. Again, now let's take that to a $3 million account. Are you going to do $3 million on a 0 day trade where you can blow, let's say, $2 million worth of it? No, that's not smart. That's not good risk management. So when you start seeing a lot of zero DTE trades, a lot of it will be either, again, I can't generalize because I can't speak to the statistics. I don't know how many people exactly or what account size they're trading on zero DTE. The only way to know that is call up everybody that's trading. But I will say in many cases, people that are doing like only zero DTE trades, they probably have an account size less than $100,000. And when you're doing something like that and you're putting a lot of that capital in there, you have a really high chance of it blowing up at some point. And you have to be very mindful. So when you start doing zero DTE and you start looking at, hey, how should I compose zero DTE? Let's say you've got a portfolio here. So here's our portfolio. Well, I might do, let's say, some iron condors. I might do some calendar spreads. I might do some trades that are, let's say calendars are 30 days. These iron condors are 180 days. I might have some long investments in some stocks. And now I have some zero DTE trades. So these zero DTE trades might be a small fraction of the actual capital that I'm using. So it's a tiny bit, not my full portfolio. Now, if your full portfolio is $5,000, I can see that can make sense to do zero DTE. But if you're starting to grow a larger portfolio, this becomes very dangerous to having, let's say, $5 million in a zero DTE trade. And the reason behind that is because what people don't recognize is that when we start looking at zero DTE, okay, what people don't get about the theta versus price is that, yes, you get a fast theta decay. You probably have seen this, but here's the inverse effect of that. What are you doing? It's a give and take, right? It's a give and take in the trading world. You buy low, sell high. Well, what are you getting? Well, the stock's trending down. When it's going down, you're taking on some risk. Well, here, if I get more theta, well, what are you giving up? Here's the inverse. Price. You got price risk. And now any big movement in price, you are hosed and screwed. So when we start looking at things like this, people don't recognize that when you're doing a 0 DTE over here, you're at the extreme end of high degree of price risk. When you do a 60-day option, okay, you have a lot less price risk. And I'm going to show you the decay here in just a second. Let's take a look at this right here. Okay, so here's just paper account that I work with when I work with people. I'm going to show you, this is what a normal account might look like. You've got a bunch of different positions here. I got Microsoft, Roku, Disney, and then I got a bunch of other stuff over here. Apple, CCL, CRM, blah, 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 boom, boom, boom. A lot of different stuff over here. So there's a lot of different things that's going on. It's not just like one big massive trade. It's a lot of different stuff happening. Okay, now, as we go into the trade and we look at SPX, if I'm going in and doing like a 0 DTE, well, look, how much premium can I get? Let's say in this case, let's go to a 1 day even in a second. But this one, the 0 DTE's got no premium. Well, because I'm almost expired. Let's go ahead to the 1 day because I'm filming this in the afternoon. Okay, let's say tomorrow, well, I can get about $1.30, $1.30. You know, if I go to a delta of about 6, well, let's go to a delta of 10, $2.50. Okay. Well, I'm going to show you something different. Let's go to a 90 day. Let's go to about a 10 delta here. Okay. Or a 10, 15 delta, $34. $34. Well, take for a minute a second here to think about this. Let's type in 255 strikes. Let's go to 155 strikes. Okay, so think about this for a minute. If we take this option and we take the, I'm going to take a nice round number, 3,700 option at $54, while 90 days out, okay, and we go to 50 days or 30 days. Let's go to 30 days. And we went to the 3,700. That option's now $15. Okay. So you went from a 90 day, 3,700, $54, okay, to a 30 day, $3,700, 16. So what am I saying here? Well, that option turns into this option with time decay. And you have a lot less price risk that's involved. So all of a sudden, you're at a $15 spread versus a, over here, a $54 spread. So you're taking this $54 spread and you're taking a ton of capital out of this. Percentage-wise, that's a big degree. Otherwise, you're trying to collect over here $2 worth on a 0 day option when you're trying to do 0 day, but the risk starts to become exponential and you're trying to collect a premium of basically $2. Now, I get it. The 90 day option, you got to wait till it gets to 30 or you got time to wait and all this. But look, the point being here is that when you deal with this kind of stuff and you're looking at just the amount of speed that this happens, you're accelerating price risk. And when you're starting to put on these spreads and positions, you got to get closer. You got to get closer to at the money. All it takes is one nasty move and you got to get out and you're going to say, well, I have a stop. Well, yeah, but what if the market just all of a sudden goes whoop and just goes down, or whoop goes the other way? If you're doing an iron condor, it becomes a problem. My point being is that on a professional level, you want to start spreading capital, different spots, different zones, all over the place. And that's the better way of thinking about it. So when I look at a portfolio, it's not bad to do 0 DTE, but in many cases, what most people do, they approach it the incorrect way. It's fine to do 0 DTE. Don't let me sway you from that, but don't tie up everything you've got in the 0 DTE. That's kind of what I'm trying to get you across, is that a 0 DTE option, when it comes to the SPX or those kinds of things, it carries a lot more price risk than further duration options. And that is the nature of it. You have a fast theta and time decay. So when you do 0 DTE, think about your portfolio, right? It's about the full portfolio. Don't just think about, hey, I got $5,000, I'm going to do $4,995 worth of 0 DTE trades. That's a very dangerous approach because it just takes 1 or 2 bad times and it can blow up that portfolio. So instead, start spreading capital in different zones and quadrants where, especially if you got larger sums of capital, let's say you've got 100 grand. Okay, we take a look at all this stuff. We'll take this here, move that out of the way. So if I've got 100 grand in that account, you might say, okay, well, let's spread this out. I might have some things that are maybe 30-day trades. I might have other trades that are 100-day. I might have other trades that are, 3-year trades where I'm okay to hold them for a long time. Think about duration, right? Duration spreads the risk. I might have some 15-day trades. I might have some stuff that's like, IRA long investments. And look, over here, I might have the sliver for 0 DTE. So if you start thinking more like this, that's fine. I'm okay with that. And I think that would be much more logical. But when you're dealing with only 0 DTE trades, you're not diversifying yourself in a time basis, because what you're doing is you're creating and crafting yourself to create much more price risk. So that's why I want to just share with you this insight in thinking about what is it that you're actually doing. This is what I deal with a lot when people go ahead and give me a call on, let's say, the coaching sessions, because I've seen people that go in and when I do these coaching calls, sometimes people have been doing well with, let's say, 0 DTE for a year, 2 years, even 3 years in some cases. And they might have taken an account from $20,000 to $200,000. And then they took the $200,000 account and it's back down to about $50,000 or something like that. So as you get larger and larger, it's fine, but you're dealing with a different ship and a different way of actually handling money. As things change from, let's say, a $5,000 or $10,000 account to a $200,000 account, you need to look at spreading capital in a much different way. So I hope this helps and opens your mind up. Again, I'm not against 0 DTE. My goal is just to give you a thought and concept to understanding it's okay to do 0 DTE as long as you're spreading out capital and cash accordingly. But I wouldn't put all your money, just like you wouldn't put all your eggs in one basket. This business is about risk management. And if you're putting everything in 0 DTE trades, you're not really managing risk, right? You're really just putting everything in one spot, and any big movement or one movement that takes you out can really be damaging. So be mindful, be a little more careful with those things. I'm not against it. Feel free to do them. It's up to you. Manage your risk properly, but understand they carry some additional risks behind them. So anyway, I hope that helps, gives you some insight, because the larger the account that you have, the less and less you'll do those trades, because you don't have the luxury of doing or dealing with micro movements because you got too much capital to work with. So anyway, that's just my thought. Take it as is. All right. Thanks for joining me. Enjoy the rest of the week ahead, and I will see you next time.